So, hey, welcome to Level Up. And today we're going to be talking about quantitative easing and Bitcoin. So, you might have seen in the news recently that institutional investors are pouring into Bitcoin. Some examples would be Stoneridge, which is a $10 billion asset fund. They now have a $115 million Bitcoin position. Or Michael Saylor with MicroStrategy, who has moved a significant part of MicroStrategy's balance sheet into Bitcoin. And so why are these traditionally risk-averse investors viewing Bitcoin as an attractive asset class for the first time here in 2020? So let's think about like how we normally think about Bitcoin being valued. So first of all, Bitcoin is a store of value. That is, as mutual people view it as a place that you can put value into. It's redeemable as well. It's also a payment medium. Both the store of value and as a payment medium, they both require on like network effects and to some extent faith from the community. But there's another reason that Bitcoin is valuable, and that's scarcity. As you know, there's only 21 million Bitcoin that is ever going to exist. And as a result, together with what's going on in monetary policy, specifically quantitative easing, the scarcity of Bitcoin creates a hedge against inflationary forces, specifically quantitative easing. So let's talk about like what quantitative easing is. So the goal of monetary policy. So you've probably heard of fiscal policy, which is how the government spends its revenues. But there's also monetary policy, which is how the Federal Reserve expands and contracts the monetary supply. The goal of monetary policy is to buy and sell government-issued bonds to reach a target interbank interest rate, basically by expanding and contracting the monetary supply. And specifically in quantitative easing, what the Fed does is they buy a fixed amount of bonds back from banks. And that fixed amount is not in value, it's in just number of bonds. And so regardless of price or interest rate, they'll purchase back these bonds, and that pours cash into banks at basically like an uncapped premium. And the idea is that cash that's now pouring into banks expands the availability of credit to consumers and sort of like stimulates the economy. The history of quantitative easing is really interesting. The first time something like quantitative easing was implemented was after the Great Depression, and that was a sort of. Really, quantitative easing, as we understand it now, is a policy that originates in Japan in the early 2000s. And it was a policy that was put into place to combat deflation in their economy. And then in 2007, the US started adopting quantitative easing specifically to combat the Great Recession. And that's, if you've heard the terms QE1, QE2, that is when quantitative easing was used for the first time here. Quantitative easing is on the rise, particularly this year. So due to COVID-19 and fiscal policy objectives, there's been $3 trillion of quantitative easing this year. Quantitative easing drives inflation. And then critically, as inflation is quite high, investors turn to scarce assets such as gold to hedge off inflation. So while the Fed can like print new money and therefore decrease its value, something like gold or Bitcoin, there's only a finite supply and therefore there's enforced scarcity. Bitcoin in particular, there's only going to be 21 million Bitcoin ever, and that's only going to change if 51% of the network participants agree on it, which is exceedingly unlikely, never going to happen. So that's the supply side, is that 21 billion Bitcoin. That's the only number that will ever exist. And that's where the scarcity derives from. Then there's the demand side. Now with quantitative easing going on, inflationary pressures are high. And so firms like MicroStrategy and Michael Saylor and Stoneridge are now looking for a way to hedge against inflation. So what does this mean for you? Let me sort of wrap this up. So first of all, Bitcoin is well understood to be scarce. There's only 21 million that will ever exist. The second, quantitative easing creates a surplus of supply of fiat money. And as a result, that fiat money is worth less. The scarcity of Bitcoin makes it a no-brainer to hedge against this inflation. And that's why we're seeing institutions that are traditionally risk averse taking those positions. So my goal with you understanding quantitative easing is two things. First, I want you to remember that quantitative easing is relatively new. And because it's relatively new, it's important for consumers to understand how it works. And I think you should consider, and this is the second thing, I think you should consider how much of your cash holdings, how much of your dirty fiat money you want to convert into Bitcoin as a hedge against inflation. Doesn't have to be a tool of just big corporations and just big fund managers. By understanding the impact of quantitative easing, you can make an informed decision on how much Bitcoin you want to hold in a hedge. Thanks a lot. That wraps up Level Up, and I'll see you next week.